$100 million in just a few days. While the market is crashing, he's on the right side of the trade. He anticipates the move, enters at the right time, and exits with a historic fortune. But what no one understands at that exact moment is that this trade didn't make him rich. It made him dangerous. Because after that moment, he thinks he controls the market. And that's exactly where everything starts to fall apart. A few years later, he has nothing left. No capital, no stability, nothing. The real question isn't how he made so much money, but how a trader capable of beating the market can lose it all. This is the story of Jesse Livermore. At 14, he works in a small firm where people speculate on prices without real access to professional markets. He observes the price action, analyzes market reactions around certain price levels, and above all, he understands something fundamental. The market is a system of collective psychology. Fear and hesitation create repetitive structures on trading charts. When he moves to larger markets, conditions change, volatility becomes harder to read, and he starts losing again and again because he always wants to be in the action. He tries to recover his losses quickly. Unfortunately, in trading, the faster you want to make it back, the more bad decisions you make and the worse your drawdown gets. He enters a negative spiral, a progressive loss of control, until the moment he understands something crucial. He slows down, he waits, he learns patience. He no longer looks for trades. He waits for setups, high probability configurations, moments when the market shows a clear imbalance, momentum, direction, structure. He makes fewer trades, but they are much cleaner and more professional trades. In 1929, the market is in a massive bull run. Euphoria is extreme. But Jesse Livermore sees something else. He sees a loss of momentum, a fragile structure, a progressive distribution. He starts building a short position progressively, without rushing, with discipline. The market seems strong, but structurally it's weakening. A collective panic sets in, liquidity disappears, prices drop violently, and Livermore is positioned for the sell-off. Every downward move in his favor increases his profit. The result, after just a few days, over $100 million in profit. After an extreme gain, trading becomes more aggressive, position sizing increases, risk management becomes flexible, then it disappears. He holds on to losses for too long. He ignores his own rules. A good analysis is not enough. Without execution discipline, a trader becomes vulnerable, and the cycle starts again. Gains, excess, losses. At this stage, it's no longer a strategy problem, it's a behavioral problem. Every decision is influenced by his ego, by his impatience, by his fear of losing, and his fear of missing out on opportunities. Even if the market is unstable, your behavior must never be. An advanced understanding of market structure and exceptional reading of price action, but he never mastered his behavior, and that's what destroyed him. His story shows a simple truth. Making money in trading is very difficult, but keeping it is even harder. If you want to progress, work on your discipline, your risk management, and your execution. Because in the end, the market doesn't destroy traders. Traders destroy themselves